Are you guys tweaking your buying strategy at all at Praxis?
Not really. I agree with your findings about smaller multifamily. In fact, I've been saying for about the last couple of months at conferences and podcasts, and I did one earlier today, same discussion. Like, where's the opportunity today? Today, the opportunity is probably in smaller multifamily. I think that's where you're more likely to find bargains because you have the quintessential tired landlord, you have the undercapitalized owners that are up against the wall. You're going to see more of that there than you're going to see in larger multifamily, where the owners tend to be better capitalized, more professional. This is their primary business, that sort of stuff. But I've already been through the smaller multifamily phase of my career. I don't really want to go back there. And we don't need to do deals. So right now we're not. And that's just, it's a privilege that I'm very happy to have, but I wouldn't say that's for everyone. So we're not currently buying at all. And I think it makes sense to talk about buying in cash and doing a refi later when the debt is more cost effective, as long as the numbers work under assumptions that the debt isn't going to get that much more cost effective. Because we really have to wonder where debt is really going to be priced 1, 2, 3, or 4 years from now and be realistic about that. I have a sense that interest rates are going to be higher for longer than a lot of people think. And so eventually what's going to need to happen is there's going to have to be cap rate decompression in order for deals to make sense with the real cost of leverage. And I think that's part of the reason why you're not seeing a lot of deal flow right now. Sellers don't want to sell because they're thinking, oh, I'll wait to sell when rates are better and I can get a higher price. Or they're saying, you're thinking rates are going to be better soon and conditions will be better soon. And if they're not, they're going to have to come to grips with, okay, it's time to sell. I need to sell. I have to sell. I want to sell. And this is where debt is priced. So I have to price accordingly. And that's going to impact their transaction value.
Yeah, and if you just think about like timeline where we are today, right? We're in 2023. Most of the deals that are going to market in 2023, let's say it was purchased 18, 19, 20. What are the rates back then? And then if you underwrote it, let's say a chapter out of your book, right? 10 basis points, let's say, of compression a year, you're nowhere close to getting a deal done today.
That's
Like
right.
you're miles away. And it's like almost like you need those deals to have some kind of conclusion, almost like a resolution. And then the next batch of deals, like the deals that are being bought today at rates of 6, 7%, they're going to be fine in 2, 3 years to sell, even if the rates are 6, 7%. It's like you could buy apples to apples. It's just the deals now are almost like it's apples to oranges from what they were 3 years ago to what they are today.
Yeah, and I would even say deals bought in 17, 18, 19 might be okay as well, just because they've probably had substantial NOI growth. When rent increases post-COVID, depending on where they're located, they may have experienced some really robust rent growth. And you could have a situation where the NOI growth outpaced the deflation effect from a decompressing cap rate. So they won't make what they thought they were going to make, but they could still make a positive return. But the deals that were bought in 2020, 2021, 2022, those are the ones that are probably at the highest risk because they haven't had a chance to see that NOI growth yet. And they missed the COVID bump. In fact, they paid a premium for the COVID bump that, that the previous owner got. And they may not have the NOI growth to balance off against the cap rate decompression. And when you think about going from a 4 cap to a 6 cap is a 50% decline in value. So it's a substantial hit.